I've summed up my 10 takeaways and thoughts about this book in this video. I highly recommend you to read the original book of the author. Mastering the Market Cycle, Getting the Odds on Your Side, by Howard Marks is a book about understanding the cycles of the financial markets and how to position oneself to take advantage of them. Here are 10 main points from the book. 1. The financial markets are cyclical, and investors need to understand where they are in the cycle in order to make informed investment decisions. 2. Understanding market cycles requires a combination of quantitative analysis and subjective judgment. 3. Investors should be cautious when markets are at their peaks and optimistic when they are at their troughs. 4. Asset prices are driven by a combination of fundamentals, psychology, and technical factors. 5. Inefficient markets can provide opportunities for skilled investors to find mispricings and generate excess returns. 6. Successful investing requires both defensive and offensive strategies. 7. Investors should be mindful of risk and focus on controlling downside risk rather than just maximizing upside potential. 8. The market is not always right, and investors should be willing to go against the consensus when they believe the market is mispriced. 9. Discipline, patience, and a long-term perspective are crucial to successful investing. 10. Investors should avoid succumbing to emotions and stick to their investment process even when the market is volatile or uncertain. The financial markets are known to be cyclical, meaning they go through periods of expansion and contraction. Understanding the current state of the market cycle is important for investors to make informed investment decisions. By analyzing past market cycles, investors can gain insights into the behavior of the markets and the economy, and use this knowledge to forecast future trends. However, market cycles are not always predictable, and it requires both quantitative analysis and subjective judgment to understand where the market stands in the cycle. Knowing the stage of the market cycle can help investors determine whether to adopt a more defensive or aggressive investment strategy, or whether to simply wait for a better opportunity to invest. By mastering the market cycle, investors can increase their chances of getting the odds on their side and achieving their long-term investment goals. Understanding market cycles is not just about analyzing quantitative data such as price trends or economic indicators. While quantitative analysis is important, it's also necessary to incorporate subjective judgment to accurately interpret market cycles. This is because markets are complex and influenced by a variety of factors, including human behavior, psychology, and politics. Therefore, investors should take a holistic approach to analyzing the market cycle, considering both quantitative and qualitative factors. They should also be aware of the limitations of their analysis and avoid being overconfident in their predictions. Finally, investors should remain flexible and adjust their strategies as market conditions change over time. By combining rigorous analysis with informed judgment, investors can make more informed investment decisions that are more likely to achieve their investment goals. Point 3 emphasizes the importance of being cautious when markets are at their peaks and optimistic when they are at their troughs. This is because markets tend to be overvalued when they are at their peaks and undervalued when they are at their troughs. When markets are at their peaks, investors should exercise caution and avoid making rash investment decisions. They should also consider selling some of their overvalued assets and move to a more defensive investment strategy. On the other hand, when markets are at their troughs, investors should be more optimistic and consider buying undervalued assets. This is the time when opportunities to buy good assets at a discount may arise. By adopting this approach, investors can avoid buying overpriced assets at market peaks and maximize their potential returns by buying undervalued assets at market troughs. Point 4 explains that asset prices are driven by a combination of fundamentals, psychology, and technical factors. The fundamentals refer to the underlying economic factors such as earnings, growth, and interest rates that affect the value of assets. Psychology, on the other hand, refers to the emotions and perceptions of market participants that can drive asset prices above or below their fundamental values. Finally, technical factors relate to the supply and demand dynamics of assets, including market liquidity and momentum. Together, these factors create a complex and dynamic market environment that drives the price of assets. Investors who can effectively analyze and balance these factors are more likely to make informed investment decisions and achieve their long-term investment goals. Additionally, understanding these drivers of asset prices can help investors identify market inefficiencies and take advantage of opportunities for excess returns. Point 5 highlights that inefficient markets can provide opportunities for skilled investors to find mispricings and generate excess returns. Inefficient markets refer to markets where asset prices do not fully reflect all available information, or where market participants may not act rationally. In these markets, skilled investors can take advantage of pricing discrepancies and generate returns by buying undervalued assets and selling overvalued assets. However, identifying these mispricings requires a deep understanding of market fundamentals, psychology, and technical factors, as well as the ability to analyze data and interpret market signals. Additionally, it requires patience and discipline to wait for opportunities to arise, as inefficient markets may persist for long periods before the mispricings are corrected. Therefore, investors who are able to identify and exploit inefficiencies in the market can achieve excess returns and outperform the market over the long term. Point 6 emphasizes that successful investing requires both defensive and offensive strategies. Defensive strategies aim to protect capital during times of market volatility and downturns. This can include diversifying investments across different asset classes and sectors, using stop-loss orders to limit downside risk, and holding cash or other defensive assets to maintain liquidity. Offensive strategies, on the other hand, aim to generate returns during times of market expansion and growth. This can include investing in undervalued assets or market sectors that are expected to perform well, or taking advantage of market inefficiencies to generate excess returns. However, successful investing also requires a balance between these strategies, as defensive strategies can reduce risk but may also limit potential returns, while offensive strategies can generate higher returns but may also expose investors to greater risk. Therefore, investors should carefully consider their investment goals and risk tolerance and adopt a balanced approach to investing that takes into account both defensive and offensive strategies. Point 7 emphasizes the importance of maintaining a long-term investment perspective. Short-term market fluctuations and volatility can be distracting and tempting investors to make impulsive investment decisions. However, successful investors understand that market cycles and fluctuations are normal and can withstand short-term market volatility by focusing on their long-term investment goals. By maintaining a long-term perspective, investors can avoid making rash decisions based on short-term market movements and remain focused on their investment objectives. Additionally, investors who are able to stay invested in the market over the long term are more likely to benefit from the power of compounding, which can generate significant returns over time. Therefore, successful investors should focus on their long-term goals rather than short-term market movements, and maintain a disciplined investment strategy that is aligned with their investment objectives. Point 8 highlights the importance of being contrarian in investing. Being contrarian means taking a different approach to investing than the mainstream consensus. This can involve going against the prevailing market trends or investing in out-of-favor assets that are undervalued or overlooked by the market. Contrarian investing requires a strong conviction in one's investment strategy and the ability to withstand short-term market volatility and criticism from the mainstream. However, contrarian investing can also provide opportunities for significant returns, as out-of-favor assets may be undervalued and provide greater upside potential. Additionally, by investing in assets that are overlooked by the mainstream, contrarian investors may be able to identify market inefficiencies and generate excess returns. Therefore, Successful investors should be willing to go against the prevailing market trends and take a contrarian approach to investing when they believe it is warranted. Point 9 highlights the importance of recognizing and managing one's own biases in investing. Biases can cloud judgment and lead investors to make irrational investment decisions based on emotions or personal beliefs. Some common biases in investing include overconfidence, confirmation bias, and loss aversion. Overconfidence can lead investors to take excessive risks or overestimate their abilities, while confirmation bias can cause investors to seek out information that supports their preconceived beliefs, rather than considering alternative viewpoints. Loss aversion can cause investors to be overly cautious and miss out on potential opportunities for fear of losing money. Therefore, successful investors should be aware of their own biases and work to mitigate their impact on investment decisions. This can involve seeking out diverse perspectives, avoiding impulsive decisions based on emotions, and maintaining a disciplined and consistent investment strategy. By recognizing and managing biases, investors can make more informed investment decisions and achieve better long-term results. Point 10 emphasizes the importance of continuous learning and adapting in investing. Markets are constantly evolving, and successful investors must stay informed about changes in market conditions and adapt their investment strategies accordingly. This can involve staying up to date on market trends and economic data, as well as being aware of technological and societal changes that may impact market conditions. Additionally, investors should be open to new ideas and perspectives, and be willing to adjust their investment strategies based on new information. Successful investors understand that investing is a continuous learning process and are committed to ongoing education and professional development. By staying informed and adaptable, investors can stay ahead of market trends and identify new investment opportunities. Therefore, successful investors should maintain a growth mindset, continuously seek out new knowledge and skills, and be willing to adapt their investment strategies to changing market conditions. Thank you for your interest in this book. Please leave your feedback on these thoughts in the comments below, or just put a like on this video. It will help me stay motivated and make more videos like this. In the description of this video, you may find links where you can purchase this book.